After observing this conflict between a business owner and their accounting personnel, I had to come and talk about this topic here. I want to tell you, profit does not mean cash. We're in business and we have people from business background, from business academic background where they studied business courses. But we also have people in business that are not from that background. They hire you, accounting personnel, to help them deal with their businesses. And sometimes explanations get so conflicting, so challenging, where the terms don't deliver sense to the business owner. So I'm here to explain to you the difference between profit and cash. One, we need to understand that profit is calculated from the profit and loss statement, but cash is the reality, what is available in business, what has happened. This is very important for us to know. Which method of accounting are you using? Many of us use accrual or cash accounting. This is very common with our small businesses, especially the startup. They may be using cash accounting, but the reporting based on the country, and specifically I'll now talk about Uganda and this concept because they use accrual accounting, most of them. So you find yourself that you're going to report on the accrual basis, but you're operating on the cash basis. So this conflict can bring a lot of issues where the business owner thinks money has just disappeared, where the profit that is reported on the P&L statement does not match the money in the bank. So where is the cash? Let's talk about it. Now, I want you to know that cash does not gross up when we talk about accounts receivable. But profit considers accounts receivable. For example, you sell stuff on credit. Someone takes products on credit. When you're using accrual accounting, it would add that to revenue straight away. You're going to debit accounts receivable and you credit revenue, right? But cash does not add up that. It does not consider that transaction if you're using cash basis. That means if this customer doesn't pay, the revenue will still be reported high, but cash will not be there because it has not been actually paid. So the process of making this person a bad debtor may take some period. You're trying to recover this money, but in the period that you're trying to recover this money, profit is being reported, including that revenue which you never received. That's one. Another thing you have to think about is inventory uses cash. If you're going to buy stock or you're going to use cash, but that particular cash does not reduce the profit. You see that? Because the profit will look at the sales, but you're using inventory, you're using cash to buy the inventory. So that will cut through the cost of sales. It will not affect the profit. In so doing, you may ask yourself, where does the cash go? So I want to explain to you, expenses will only show up if this inventory is sold, so that we are trying to recover our money. But in the time being, you're ordering, you're paying, it is not reflected. So I want us to know why this is like this, because it's not easy to explain to your boss if you are in this situation as an accounting professional, especially the ones that are just starting. Experience is still being built, and again you may find a very aggressive boss, so may not be able to understand you. I'm helping you using this video. I want you to know that when you see the loan payments we make, they only affect cash, they don't affect profit. Now here the thing is, only interest is reported in the P&L as an expense, but when you're paying out these loans, you're paying cash. So at the end of that day, the profit at that point is not affected until we come to the closure, until we come to the balancing. Don't forget which method are you using. This is a scenario that happened between someone who receives money and pays out money, receives and pays. Literally, they are using cash. Now they are going to report based on the international reporting standards, which for that particular country require them to use accrual. The question is, why do I see this profit being reported this much and I don't have this cash in the bank account? Let's talk. Another thing you should know, you see this principal payment, when you're paying loan, there is that interest part of it, but there's also the principal part of that loan. The principal only reduces cash, does not reduce profit. You remember? Because this loan is going to be reflected in the liabilities at some point in the balance sheet. I'm trying to explain to you because this became an issue where your board thinks maybe money just disappeared, and all these reporting standards you're explaining, the accrual concepts, the matching concepts, I have to match this with the revenue, with the expense. They cannot understand the terms at that point. But I'm trying to give them a highlight on how things happen and how accounting standard affects your reporting and your results, and how reality is when it comes to business operation. I want to tell you, big expenses that don't fully show up on the report may affect you. For example, equipment purchases. You see that equipment purchase, it's going to be reflecting in some way. It will come as an asset, but it will only appear on the profit and loss as a depreciated item or depreciation expense. The question is depreciation a cash item? No, it is non-cash item. Let us talk about the software and prepaid expenses. They are prepaid with the cash, so they become an asset on the balance sheet as a current asset. But so if you still say we made profit this much, we use these assets to generate this revenue, yes, where is the money? So this takes someone to understand how things work. Security deposits. Someone gives you this money and you put it in the what? In the bank account. You record that security deposit as an asset, right? In the so doing, if you don't have enough operational cash, let me say, you're going to withdraw this money and use it in operations at the end of that day. So let's also think about the owner's drawings. And this is very interesting with the small businesses. You usually withdraw money for personal use, or usually eat or do whatever, and you send someone to come to the accountant and they pay. All that is cash moving. So owner's draws are not company expenses, but they are taking company cash. And that's why I've always emphasized the difference between you and your entity. You're a separate legal entity. You're yourself, and your business is your business. Literally everything you take from business, please pay for it. That's the only way we can account for your expenditure as the business owner. So this also reduces the cash, but it doesn't reduce the profit. So we'll say we made profits of so much, and again, cash of, what happened. Let's see. Also, timing is everything. We have profits that show performance over time. A period, let me say a full year, let me say 2025, since it just ended. So you're seeing that, but cash is only looking at the liquidity as of right now. In the year of 2025, we might have made, let me say 30 million Ugandan shillings as in terms of profit. But the question is, what is the cash right now? Because that profit is made throughout the year, but cash is telling you what is existing as of now. The difference is the timing. Profit is giving you a span of time. Cash is telling you what is existing now. So that is the difference. The thing is, understand the method of accounting that you're using, the basis, and understand the principles around the basis that you're using. But the thing is, they don't take this money. I see this bias with accountants most of the times. When you're speaking to other people who are not in the profession, they'll be like, oh, accountants are like this, accountants are like this. Sometimes you listen to them and you just okay, he's speaking from this background. Maybe he's speaking because he's not been informed about ABCD. So profit is not cash. CPA Jovia Nakaima.